Hi, everybody. David Blain here, CEO of BlueSky Wealth Advisors. Wanted to talk to you today a little bit about inflation. I've been getting a lot of questions about inflation. Some headline numbers came out recently from the government with some large increases year over year in inflation. I just thought it would be useful to kind of talk about what is inflation, what's going on, and why we should or should not be overly concerned about it. So first of all, just kind of the headline numbers, there was a 0.6% jump in May in the core inflation numbers. 3 month, previous 3 month numbers up about 2%. So what's going on? Are we just getting back to normal from COVID or a return to the 1970s and 80s type inflation? So we'll talk about that here for a few minutes. First of all, as economist Milton Friedman said, inflation is always and everywhere a monetary problem. So what is inflation? Inflation is when the wholesale price of goods and services and labor and economy rise. What inflation is not is the price of stuff just going up. And what do I mean by that? When you go to the grocery store and milk goes up in price, it does not necessarily mean inflation. That's the price of your stuff going up. It could be a supply and demand issue, as you know, from sort of basic economics, the supply and demand curve. As supply and demand shifts in a free market economy, the price shifts along with it. And so inflation is distinct from just the price of things going up or down. Inflation is when the wholesale rise in everything in an economy goes up, and that is caused by too many dollars chasing too few of goods. When it's on an individual product or certain things, then it's you can call it inflation, but it's really the price of that product going up in the supply and demand curve. If you think of inflation as sort of a permanent shift in that whole curve, so that all prices are going up. And with the Federal Reserve pumping all sorts of money into the economy, sending out checks to people that don't even know what they're for, unemployment money, COVID money, money for everything, money flying everywhere, low interest rates, people borrowing money for nothing. You have a lot of money floating around in the system. And when you don't have enough goods, people bid those things up and the price of everything sort of goes up. The way I like to think about economies, it can be hard when you think of the whole world and the US, and it's so complicated and everything. What I like to do is think about an economy, just think of an island, a remote island, in the Pacific or Caribbean, wherever you want to think of it. And just think of there's maybe 10 people on the island. And the currency that they use is oranges. And so if all of a sudden you have a bumper crop of oranges and everyone is flush with oranges, then the people will demand more oranges for the things that they need to trade with each other. Same thing with money is if I used to have, $1,000 in my bank and now I have, $2,000, I may be willing to spend more of those dollars for something than I was a year ago. Anyway, one of the main things I want to talk about also is what we call the base effect. What's going on in the economy. And one of the things you've got to remember with this, what's happening with inflation is that they're year over year comparisons usually. And so what was happening in June of 2020, man, the economies around the world were depressed. You had economies shutting down. You had people out of work. It was kind of, really dark days. And so now as we're looking at year over year, May of 20 to May of 21, you have what's called the base effect. And so the number that you're going from is very small, and you look at that as a year over year growth, and it's very high. The same thing's happening too with economic growth. The numbers that we're comparing it to last year are very small or even negative in some places. And so it looks like these giant gains, but what you're really doing is you're only getting back to normal. In fact, I have a little chart that I want to show you here. This is a graphic put out by Vanguard, and you can see in the top chart here the trend line and how we dipped below trend last year, and we're just now getting back to the trend line of inflation. And so whenever you're looking at the effects of this, you have to account for where you started. And so it looks like, you know, the little dip, we're just getting back to trend. And so that's going to necessitate some bumpiness as we get back to back to trend. Okay, so I just wanted to share that little graphic with you, talking about the base effects, how when you have a decline, getting back to normal can sometimes seem like a large jump. I do think there's a lot of supply and effect going on here with the supply chain. I'd like to look at a couple of figures for you. As I said, the numbers did increase 0.6 in May. Over the past 3 months, core CPI increased 2%, the most since July of 1982. Now, look, I know there's a lot of numbers, but kind of stick with me here. There's some good stuff. So one of the things in core CPI is auto prices. 7.3% gain in used car and truck prices in May. A huge driver, the second most on record. And guess when the highest on record was? In April, with a 10% increase. So used cars and trucks prices are going up. And why is that? Is it because of massive inflation? No, it's because new car and truck supply is constrained. You know, factories shut down in COVID. There was no demand for new cars, things like that. And so we've now got a swing of demand, people now getting back out, looking to replace cars, things like that. So not only is there that demand surge, but also on the supply side, they're having some trouble with chips, semiconductors and some other supplies as emerging markets still struggle with COVID. And so the supply of vehicles is down and the demand is surging. And so you see these large increases in price. And that's an example of something that's probably going to be transitory, and that inflation will subside in the vehicle prices. Some other interesting numbers: household furnishings up 1.3%, airfares up 7%. Once again, the same thing. Last year at this time, the airlines couldn't give an airline ticket away practically. You saw these crazy low fares if you were willing to fly last year. Well, that's changed, and people are surging back to the airports. People want to fly again. And so you see airline ticket prices going up 7% last month. Apparel, shelter, which is the biggest component of CPI, was up 0.3%. Of that, rent 0.2%. So if you annualize that, you know, that's 2.4% a year. Not bad. Lodging away from home, you know, hotels, things like that, similar to airlines, prices jumping up only 0.4% last month, but a record 7.6% surge in April, the same thing. And so when you look at some of these supply chain disruptions and things like that, it's possible that as these things get worked out post-COVID, we'll return to, you know, sort of a normal, the Federal Reserve target is 2%. And so maybe we'll return back to that 2%. I think there are some structural things in the economy that are going to lead to longer term, higher normal rates of inflation. At this point, we don't see any reason to think that we're going to get back to the, 7, 8, 10, 12, 15% of the 70s and 80s. But I would anticipate, our core target for inflation for the long term, instead of like 1 to 2% that we've had the previous decade, I think more like 2 to 3% will be more reasonable. I mean, one of the things that's happening, and I don't want to get into the politics of it, but the reality is when you raise the minimum wage to $15, or you give out raise unemployment, raise subsidies for the Affordable Care Act, all these things where you have upward pressure on prices. Let's face it, if you could work at fast food for $15 an hour, someone providing other types of work is not going to be content for $15 an hour. And so it provides upward pressure on all prices in the economy. And so those factors, along with as you give away more free stuff, frankly, if college is free and parents no longer have to save for college, well, they don't get their pay at the job cut. And so those extra dollars from that, or the increased healthcare subsidies, or whatever they're spending their money on, as you have more outside government involvement in that, you're going to raise the inflation rate, because now you have more dollars chasing fewer things. As the government printing money, you have more money in circulation. So once again, I'm happy to talk about whether it's right or wrong. That's not what this is about. It's simply more dollars in the economy by government programs, raising the minimum wage, things like that, do have an inflationary effect. So long term, we're probably going to tweak our long-term estimates, like I said, more in the 2 to 3% range, rather than the 1 to 2 as it's been the last decade. Now, the other thing about inflation, you got to be careful, is it's a self-fulfilling prophecy. As Charlie Munger, who's Warren Buffett's partner, says, that markets are what's called a complex adaptive system. And what happens is they adapt very rapidly to incoming new information. And so as we saw last year with toilet paper, as people think there's going to be a scarcity, guess what? There is a scarcity, because everybody runs out and goes and buys up all the toilet paper. Same thing with gas. We here on the East Coast, maybe a month or so ago, we had the Colonial Pipeline ransomware attack and shut the pipeline down. And so what happened was, all of a sudden, gas became very scarce, and people, the price of gas skyrocketed because of the scarcity of gas. As people thought it was going to be scarce, they went and filled up their tank, which further drove the price up. So it's a cyclical, self-fulfilling prophecy whenever you have these type of things. And so the same thing with inflation. If everybody thinks there are going to be high inflationary problems, people take actions that indirectly can increase the inflation. At the same time, and you don't know ahead of time how it's going to work out, how many people, but you can also have, as people take action to minimize the effects of inflation, it can actually eliminate it. And so trying to predict these things ahead of time is very, very difficult, if not impossible. If it was easy to do, if everybody was right, our economy would be vastly different than it is. But there are certain things. Technology, of course, is a downward pressure on inflation, as well as certain types of globalization. As we saw in COVID, it's not good to have your entire supply chain with one country. But the fact is, as you can diversify your supply chain, it does have a downward pressure on prices. And also, of course, the big one, monetary policy. Our central banks, Federal Reserves around the world have the ability to increase or constrict the money supply, increase rates, lower rates, bond buying programs, things like that, that can help. In theory, they can help. It'll be tested. So far, they can help with inflationary pressures. So once again, to summarize, we did have some sort of eye-opening numbers in inflation the past couple of months. Don't forget the base effects were coming off very low numbers, and also some of the supply and demand curve, some of the normal functioning of the economy, reduced supplies, increased demand is driving some of that price. So my point is, it's too early to say if we're in for a period of higher sustained inflationary rates, but we will certainly keep up on the situation and let you know as our thinking changes. But right now, we're going to be watching it for another couple months to see if we can't get some of these supply chain issues sorted out. Well, thanks for listening and watching, and stay tuned. We'll send out some more information as the situation updates.